U.S. stocks are rallying on this Friday afternoon with the Dow Jones Industrial Average and S&P 500 topping key levels. This does come on the heels of a much better than expected U.S. jobs report. And joining me this afternoon to weigh in on the action on the floor as well as for that jobs report is Peter Cardillo of Rockwell Global Capital. Peter, happy Friday and thanks for joining me.
My pleasure.
Well, so much for that saying, sell in May and go away. We did see a better than expected jobs figure, non-farm payroll-wise, and also upward revisions to March and February's figures. And of course, that unemployment rate also dipped to a low not seen since 2008. But what do you make of the numbers?
No question that the numbers were better than expected, certainly a lot better than I was anticipating. But you know, if you factor in the two numbers together and you look back to the beginning of the year, the economy is probably creating about 175 to 185,000 jobs a month. Now that's not really a great number in the sense that it's going to take the unemployment rate down to 6.5%. That is the Fed's target anytime soon. So I think, you know, while today's number certainly was much better than we anticipated and confirms that the job market is basically steady growing, it doesn't alter the fact that the Fed is about to taper off their bond buying program. In fact, you know, this week the FMOC basically said that that they are somewhat elastic in terms of stimulants. They could either increase them or decrease them. So I think the reason why the market is applauding the numbers today is that it just means that the most powerful drug that the market has is going to stay intact. There are good indications that probably the ECB will soon begin to have to print money. And so that just makes the equation of the stock market versus to zero interest rates even more interesting.
Well, Peter, you've brought up a lot of important points there. Summarizing what we've seen this week in terms of the FOMC statement, that little adjustment to the language, whether they would reduce or increase depending on what we see in the economy. And we did get that ECB rate cut and some interesting comments out from the European Central Bank, which did affect the euro currency yesterday. But it all does come down to central banks and what they do going forward. Now, next week on the calendar, it is fairly light on the U.S., but we get some global economic data releases as well as a handful of central bank rate decisions. So on top of technical levels, what will you be watching?
Well, you know, I think next week the market is going to look at the technical aspect of it, of this recent surge. And we could be seeing a little bit of a battle brew between the bears and the bulls, only because of the fact that, you know, this market has gone up quite strongly and has reached record levels, Dow 15,000 and the S&P breaking the 1600 level today. So that's going to present, I think, a little bit of a technical battle next week in lieu of the fact that we have a very light economic calendar next week. In fact, there are only two feature reports next week, jobless claims on Thursday, and on Friday, the federal budget. By the way, we might see for the first time the budget register a net gain of about 10 billion as opposed to a swelling of negative readings. So that could be interesting. But I think you know, earnings season basically winding down, and again, you know, if you look at the earnings, no question that most of the companies have beaten earnings expectations, but revenues certainly have been on the downtrend, and guidance has been murky. That's been on the rise. So all in all, you know, the market, I don't think, is going to be paying attention to the earnings, and so I think it's going to be a week of technicalities that's going to drive the market next week.